Welcome to this session on property appreciation, the engine for growing your property investment portfolio. Today we're going to dive into how property appreciation can power your investment journey, helping you build a portfolio that grows on itself. Whether you're new to property investing or looking to take your portfolio to the next level, understanding appreciation is critical. This is the EDPF Property Academy 10-Minute Property Tips, where we talk all things property in just 10 minutes. Let's start at the beginning. What is property appreciation? Property appreciation simply means the increase in the market value of a property over time. It's how the same home that cost 500,000 Rand a decade ago might now be worth 1 million Rand or more. There are two main types of appreciation: natural appreciation and forced appreciation. Natural appreciation happens because of external forces like economic growth, demand for housing, or inflation. For example, a suburb might suddenly become popular because of new infrastructure like a shopping mall or a transport hub, pushing up prices without you having to lift a finger. On the other hand, forced appreciation is where you, as the investor, actively increase the property's value. This could be through renovations, modern upgrades, or converting a property to serve a higher demand market. Both types of appreciation are powerful tools for growing your wealth. So, why should property investors care so much about appreciation? Firstly, it builds equity. Equity is the difference between your property's market value and what you owe on your bond. As your property's value goes up, so does your equity, and that's pure wealth. Secondly, appreciation gives you access to capital. You can refinance your property based on its higher value and extract cash without selling it. That cash can fund new deals, renovations, or reduce other debts. Third, appreciation enables portfolio leverage. Instead of saving for years to buy another property, you can use the equity in one property to help finance the next, snowballing your growth. It's also an excellent hedge against inflation. While money loses value over time, property values and rental income often keep rising, helping preserve your wealth. And finally, appreciation allows you to sell properties at a significant profit when the market is strong, which can be a powerful way to rebalance or expand your portfolio. Let's talk specifically about what drives property appreciation in South Africa. Several factors come into play. First, economic growth and employment. When people earn more and feel secure in their jobs, they are more likely to buy property, increasing demand and pushing prices up. Second, infrastructure development. New roads, transport hubs, hospitals, and malls make neighborhoods more attractive. For example, areas near Gautrain stations have seen significant price jumps. Urbanization is another driver. People continue to move from rural areas to cities, creating housing demand. Supply constraints also play a role. In cities like Cape Town, limited space means even moderate demand keeps prices stable or rising. Interest rates influence affordability. Lower rates make bonds cheaper, increasing demand and prices, while higher rates slow things down. Gentrification transforms older, neglected areas into vibrant neighborhoods, pushing prices higher. And finally, community amenities, good schools, parks, and hospitals all attract buyers and raise property values. Understanding these drivers helps you choose the right places to invest. It's important to understand the difference between natural and forced appreciation. Natural appreciation happens because of the broader market. It's slower, less predictable, and driven by factors outside your control, like interest rates, local demand, or economic cycles. Forced appreciation, however, is entirely in your hands. You actively increase the property's value by making improvements or managing it better. It's typically faster and can deliver significant returns on your investment. Think of natural appreciation as riding the tide, while forced appreciation is rowing your own boat. Most successful investors combine both, buying in areas with strong growth potential and then adding value through strategic upgrades. Let's dive deeper into forced appreciation strategies. These are some of the most powerful ways to create value in property investing. Renovations or modern upgrades are one of the most common methods. Updating kitchens, bathrooms, and flooring or improving the exterior can dramatically increase a property's value. The key is to calculate the cost versus the potential added value or rental increase. Adding extra rooms or outbuildings is another approach. For example, building a garden flatlet can create a new income stream and boost the property's resale value. But you must research demand in your area and ensure you follow municipal regulations. Improving energy efficiency has become a significant selling point. Solar geysers, LED lighting, and water-saving fixtures not only reduce expenses, but can increase the property's value because tenants and buyers appreciate lower utility costs. Subdividing or rezoning property means splitting a large stand into smaller plots, or changing how a property can be used, for example, from single residential to multi-residential or commercial use. This requires professional help from town planners and careful municipal applications, but it can dramatically increase a property's worth. Converting single dwellings into multi-let units is highly effective in areas with demand for shared accommodation, like student housing or communal living. Instead of earning 8,000 per month from one tenant, you might earn 20,000 rand from several tenants sharing the same property. Always check zoning laws and ensure proper facilities like additional bathrooms and fire safety compliance. Finally, better tenant management can boost rental yields without even touching a hammer. Keeping your property well maintained, screening tenants carefully, and maintaining good relationships can reduce vacancies, increase rental income, and ultimately raise the property's market value. These strategies allow investors to actively create wealth rather than simply waiting for the market to deliver returns. Now let's talk about equity growth. Equity is simply the difference between what your property is worth and what you still owe the bank. For example, if your property is valued at 1.7 million rand and you owe 900,000 rand, your equity is 800,000 rand. Equity grows in two ways. Through appreciation, as your property's value rises, and through paying down your bond over time. This growing equity is incredibly powerful because you can tap into it to finance other investments. For instance, you could refinance your property, borrow against your equity, and use that cash as a deposit on a new property. In this way, your property becomes more than just an asset, it becomes a financial tool for further growth. So how do investors use equity to grow their portfolios? There are several methods. You could refinance your property and increase your bond to release cash based on the higher value. You might take a second bond against your equity. Or, if you have a flexibond facility, you could access surplus funds directly. This capital can then be used for deposits on new properties, renovations, or even covering purchase costs, helping you expand your portfolio without saving large amounts of cash each time. Of course, there's risk. Borrowing more increases your monthly repayments, and interest rate hikes can squeeze your cash flow. That's why you need to run careful affordability calculations and ensure your rental income can comfortably cover any new debt. When used wisely, equity is the key to building wealth faster than relying on your own savings. One of the smartest ways to build a property empire is the equity recycling strategy. Here's how it works. First, buy a property below market value. Look for distressed sales, auctions, or properties needing renovations. Next, add value through forced appreciation, renovate, improve management, or upgrade the property. Once the value has increased, refinance the property based on its new market value and extract equity. Use the cash as a deposit, or even the full purchase price, on your next investment property. Then repeat the entire process. This creates a snowball effect. Each successful deal funds the next, allowing you to grow your portfolio much faster than relying purely on savings. Let's look at a simple example. You buy a property for 1.5 million rand, spend 200,000 rand on renovations, and raise its value to 2.2 million rand. You refinance, pay off the original bond, renovation and refinancing costs, and walk away with 460,000 rand in cash. That money becomes your deposit for the next deal. This strategy can turn a single property into an entire portfolio over time. Before wrapping up, let's touch on some important considerations. Timing your exits is crucial. Selling during a market upswing can maximize your gains. Selling in a downturn often means lower profits, or even losses. Taxation also plays a role. When you sell a property at a profit, you'll pay capital gains tax. In South Africa, only a percentage of the gain is included in your taxable income. It's important to plan for this. If you're developing or improving residential units, check whether you qualify for Section 13 SEX tax allowances, which allow you to claim depreciation on new residential buildings. Market research is essential. Look for suburbs with rising demand, planned infrastructure projects, and employment hubs. Avoid investing purely on speculation, without data to back up your decisions. Diversification helps manage risk. Don't put all your properties in one suburb, city, or property type. Spread your investments across different markets. And finally, practice risk management. Keep your debt levels conservative and ensure rental income covers your expenses, even if interest rates rise. With careful planning and a solid understanding of appreciation, you can build a resilient and growing property portfolio. So, to wrap up, property appreciation is not just about waiting for the market to do its thing, it's about strategy, action, and careful planning. Understanding how to buy well, force value increases, extract equity, and reinvest those funds is how property investors build serious wealth over time. Thanks for watching. We hope this session has given you insights into how to make property appreciation the engine that powers your portfolio growth. Thank you for being part of the EDPF Academy, #1 Million Title Deeds Project. We hope you will continue your journey to property ownership with us by registering for our Academy course at www.edpfacademy.app or visit our main site at www.edpf.co.ca for more information about EDPF.